Hello, and welcome to the August 2024 issue of the Zavitz and Sykora Financial Strategies video newsletter. Thank you for tuning in and listening to our update. I'm your advisor, Greg Sykora, and joining with me today is my partner, Mark Zavitz. Today, we're going to talk to you about volatility, what we just saw over the last month from a volatility standpoint, and what you can expect performance-wise from your portfolio based on the model you're invested in. So let's get started. Well, if you didn't pay attention to capital markets, or if you don't pay attention to capital markets on a daily basis like Mark and I do, you probably didn't notice the big bout of volatility all the global stock markets had at the beginning of the month. Here's a snapshot of the Japanese stock market, the Nikkei, going back about 1 year. We had a few clients reach out to us, and thankfully, the drawdown that all equity markets had reversed pretty quickly. And not to bore you with the details, but what caused it is in Japan, interest rates have been low for about 3 decades. And at a time where inflation is coming down globally and central bankers across all countries across the globe have said, we're going to start lowering rates, Japanese central bankers said they're not going to lower rates. They're probably going to keep rates the same, or they might even increase rates. And that spooked the economy, that spooked the world. Japanese markets and Japanese currency has been quite low for a very long time. And if countries keep their rates low while other countries, they keep the rates high while other countries are lowering their rates, it boosts the strength of their currency. And this is essentially a bet that global markets have had for a long period of time, that the Japanese market is going to stay low and currency is going to stay low in perpetuity. And this blew that bet up. And when it blew that bet up, the Japanese stock market, the Nikkei, went down 12% in 1 day. But what quickly followed was Japanese central bankers retracting that statement the following week, saying, you know what, that's not actually what we're going to do. We're going to follow what the rest of the globe is doing. And if everyone's lowering rates, we'll probably lower rates as well. So a complete 180. And so 2 days after the market went down, the Japanese market, Nikkei, went down 12%. The Canadian and US markets were down 3, 4, 5%. European markets were down about 5%. Everything shot back up. And the Nikkei, the Japanese market, the one that was affected the most, it shot back up 10% in 1 day. So if you panicked and you sold, you took a very, very heavy loss. And so why talk about this? Well, it's a reminder that although things are going well and have been for the past year, everyone's had some really good returns. We will experience more volatility like this at some point, and that's okay. On average, we see about 3-5% pullback corrections a year. And every 2 years, on average, we see a 10% correction. It's normal. It's healthy for markets to go down. And all you have to do when it happens is just sit back and let it correct back to normal, especially during big bear markets like what we see on the screen. Time will always fix big negative returns. Obviously, it's easier said than done because when markets go down, it invokes, an emotional response, but that's just the reality. Markets always go up in the long run. And on average, it takes about 1.5 years for big bear markets to course correct and start regaining losses. Markets are going up about 80% of the time, and they're going down about 20% of the time. And when markets do go up, as seen here, the cumulative average return of the S&P 500 stocks, which make up a big part of your portfolio, is 177.6%. Basically, you don't want to miss it by selling out when it's going up. And that's what Mark and I are paid to help you do. Mark, you've experienced some of these big drawdowns. You've been an advisor and looking after people's money for around 40 years. I mean, you don't want to miss the bad returns, but we can't forecast when things are going to go down. What's your experience been like during some of these markets? And what have you been telling clients?
Well, Greg, You know, you're absolutely right. Everyone certainly enjoys the blue part of this graph or this diagram. The bull markets, like you said, run 1 year to 4 years, maybe on average 1 to 2 years, and the cumulative growth is 100, 200, 300, sometimes even 400%. So my take on this is that you just have to stay invested. And what we try to do with our clients, what I've tried to do for 40 years is just hold people's hands and try to be a calming effect when we go through short periods of time where the market corrects significantly, like just happened a month or so ago in Japan. You've got to take the bad to get the good, and market timing does not work. You got to stay invested. Warren Buffett says it very simply. Build a low cost portfolio and never sell. And that's it.
Exactly. No, it's true. It's not timing the market, it's time in the market. Time will always course correct. If you just happen to get unlucky and invest when things are going down, as long as you don't sell and you hold, eventually it'll get back to where it was and then start making new highs.
Yep.
So here's an interesting chart that shows what follows bad bear markets. The S&P 500 has averaged around a 10% return since 1950, as seen by the yellow line. What follows a bad year is typically a very good year. As an example, the last bad year we had was right around the time that I started back in 2022, and the S&P 500 was down about 20% as inflation scares started hitting capital markets. And in 2023, a rebound year, the S&P 500 was up 23%. Very similar to what you see on the left side of the screen here of the graph as an average over the past 70 years. Subsequent returns after a big correction are usually always good and erase a big chunk of what was lost, if not all of it. Again, proving that waiting and doing nothing, or perhaps even if you're courageous enough, adding some risk when markets go down is usually the right thing to do if you have a medium to long-term time horizon, which, unless you're in your mid to late 80s, is what everybody has. And here's what you should expect for returns after fees for your portfolio. If you're in the very conservative portfolio, which I'd say about a quarter of our clients are in, you should expect around a 4% return on average over a full market cycle. Full market cycle is around 7 to 10 years. If you're in the conservative model, it's around a 5% return after fees. If you're in the moderate model, it's around a 6% return after fees. If you're in the growth model, it's around a 7% return after fees. And if you're in the aggressive growth model, which there's only a handful of clients in, myself included, but because we're younger, it should be around an 8% return after fees. What I did was when I built the model, I modeled everyone's portfolio to go back to 2008, which was probably one of the worst corrections we've ever seen and will hopefully ever see in our lifetime. Modeling it back to 2008, the very conservative model lost around 10% in 2008. The conservative model was down around 13%. The moderate growth model was down just under 19. It was 18.5, so we'll say 19%. The growth model was down 33, and the aggressive growth model was down 48. So these are all, this is all downside that our models captured, but was only down for about a year and a half. And in 2009 into 2010, it regained everything it lost. And in 2011 was starting to make new highs again. So everything that it lost was temporary. And eventually, as long as you didn't sell, you regained everything that you lost. And then by 2011, 2012, it was making new highs and you were making money again. The reason I show this is that, you need to, as Mark said, take some of the bad in order to get the good. And I don't think that we're ever going to experience a 2008 downside event again in our near future, but it's always possible that it happens. And in the worst market pullbacks, this is how badly the portfolio is performed. I wouldn't say it's that bad at all. Most of you are invested conservatively or moderately. So by that point, you'll have made likely some good returns. So if we only go down 10, 15, 20%, it won't feel like you've lost too much. And that's it. I hope everyone has had a really good summer as we head into September. We look forward to having our next monthly update at the end of September. Please feel free to reach out to us if you have any questions or want to talk about your portfolios. And as a reminder, we will be reaching out to you, like we said in our previous video, to rebalance your accounts. And that is because we've updated all of our models. So expect to hear from us in the next 2-3 months to talk about rebalancing your portfolio. Thanks so much and hope you have a great upcoming month of September.
Have a nice long weekend, everyone.
Thanks. Have a nice long weekend.